Cost of capital. Another chapter is cost of capital. What is cost of capital? Cost of capital. Cost of capital. Capital's cost. With concern with the company, each investment company should pay return to their investment. Each investment company should pay return to the investors. That expectation of return of investors is called cost of capital. Expectation of return of investors is called cost of capital. Expectation of return of investors in company's point of view, it is a cost. Investors point of view, it is an income. It is a benefit. Company's point of view, it is a cost, and investors point of view, it is a benefit. Hence, company's point of view, it is a cost of capital. There are a lot of sources of capital. Company can raise fund from either equity share capital, preferred share capital, debentures, loan fund, different sources of capital is there. Okay. Okay. Each source, the learning objective of these chapters are cost of debt. How to compute cost of debt fund? Cost of debt fund, that is, there are two methods, shortcut formula and IRR method. IRR method or present value method. Present value method or conceptual method. Present value method. Shortcut formula, IRR method. Cost of preference share capital, KP. Shortcut formula, IRR method. Present value method. Cost of equity, we need to learn. There are different methods. Constant earnings approach, earnings price approach. What's called earnings approach, price approach. Constant earnings approach, constant dividend method, dividend growth method, capital asset pricing method, CAPM method. This is K, cost of equity. Cost of equity. Then cost of retained earnings, KR, cost of retained earnings. Then we learn weighted average cost of capital. Weighted average cost of capital based on book value weights, market value weights, marginal cost of capital. This is the learning objective of these chapters. Company require finance for making investment. Company require finance for making investment. The finance may be obtained broadly from three sources. Namely, debt fund, preference shares, equity shares. Debt fund, preference shares, equity shares. The fund provider expect something in return for the capital given, and this expectation, if we quantify as a percentage, is called cost of capital. The fund provider expects something in return for the capital given, and this expectation, if we quantify as a percentage, is called cost of capital. Cost of capital. Cost of capital is the discount rate used by capital budgeting technique. Cost of capital is the discount rate used by the capital budgeting technique. That is, as we know, for the computation of NPV and PI, we use cost of capital as a percentage of discount factor. Clear? Cost of capital is a discount rate used by capital budgeting techniques like NPV, IRR. Not IRR, NPV, PI. It is the minimum rate of return a project should earn. It is the minimum rate of return a project should earn. Minimum. Suppose, listen here. This is the balance sheet. Company collected total 5 crore, 5 crore, 5 crore capital from different sources of capital. Equity, preference, debt fund. Company collected different sources of fund. 5 crore rupees collected. Then company needs to company invested. This is financing decision. This is financing decision. Okay, this fund company invested in different sources. Company invested in different sources, different investment. Fixed either fixed asset, invested in fixed asset or current asset. Company invested in fixed asset, long term investment or short term investment. Then company earns return. Company earns return. Company earns return. Okay. Company needs to pay return to the investors. Needs to pay return to the investors. Investors' expectation or cost of capital for this capital investment is suppose 20%. Cost, what is the cost of capital? 20% is the cost of capital. 20% is cost of capital. Definitely for running this business without loss, for running this business, company should earn more than its 20% return. If company earns 25% return, company can pay 20% to the cost of capital to the investors. If the company earns less than cost of capital, company cannot run the business. That means minimum return, at least minimum what rate company earn for their investment. Minimum 20% company should earn. Clear? Cost of capital is a discount rate used by capital budget agree. It is the minimum rate of return a project should earn. It is the minimum rate of return a project should earn. Clear? This 20% cost of capital is called overall cost of capital. 20% cost of capital. If for the five crores, listen here, 5 crore capital we collected, 3 crore from equity share capital, 1 crore from preferential capital, and 1 crore from debt fund. This overall cost of capital is 20%. Company needs to pay return to the equity shareholders, preferential shareholders, and loan fund also, debt fund also. Overall cost to the company is 20%. Cost of capital is 20%. Clear? Okay. That 20% is the return, minimum rate of return project should earn. In the first segment of this chapter, we learn to calculate the specific cost of capital. What is specific cost of capital? Yes, cost of equity, cost of debt, cost of preference shares. Separately, we are going to learn. Cost of debt means KD. Cost of preference shares means KP. Cost of equity shares is called KE. In the first segment of this chapter, we learn to calculate the specific cost of capital, and in the second segment, overall cost of capital. Overall cost of capital is KO. Overall cost of capital means total KD, KP, KE. KE. Total of KD, KP, KE is called overall cost of capital. Clear? This is also called weighted average cost of capital. This is also called a weighted average cost of capital, combined cost of capital. Clear? Yes. First segment we are going to learn cost of debt, cost of equity, cost of preference shares separately. Source of finance, bond fund, debt fund. Bond fund again we classified as equity shares, preference shares, and retained earnings. Equity shares, preference shares, and what is retained earnings? Company set aside a part of profit to retained earnings or reserves. If company utilize this reserve for their new investment, then it is called retained earnings. Utilization of retained earnings. So retained earnings also one source of finance. Retained earnings also Another one source of finance. On the fund, we can classify it as equity, preference, and a retained earnings. Retained earnings, if we use retained earnings as a new another source of finance, then the cost of retained earnings also we need to find out. Cost of retained earnings also we need to find out. Clear? Debt fund. Debt fund, yes, another source. The return required by provider of capital is called cost of capital. In this chapter, we learn how to calculate cost of capital. In this chapter, we learn how to calculate cost of capital. Clear? Okay. Cost of debt. First, we are going to learn specific cost of capital. Cost of debt, cost of preference shares, cost of equity, cost of retained earnings. KR. KD. There are two methods, two formula. For the debt are two types. Irredeemable debt and a redeemable debt. What is irredeemable debt? What is irredeemable debt? Company won't return their capital. Company each year or some specific period, company gives return to the investors like interest. Company pay interest to the debt holders. Company won't return their capital. Capital investment they won't return to the debt holders. Then it is called irredeemable debt. Irredeemable debt won't be redeemed. What amount? Suppose if an investors, if a debenture holders or a debenture holders invested into the business 10 lakh rupees, 10 lakh rupees invested. Each year company needs to pay 10 percentage interest, debenture interest. What amount the company has to pay to the debenture holders? 10 lakh. 10 lakh into 10 percentage, 1 lakh each year they have to pay to the debenture holders. Each year 1 lakh, 1 lakh, 1 lakh they will pay. They won't return 10 lakh to the debenture holders. Then it is called irredeemable debt. Example is irredeemable debenture. Irredeemable debenture. Irredeemable. But actually, in case of irredeemable debentures, when the company returned their debt fund at the time of winding up of the company, at the time of winding up of the company. Clear? Then redeemable debt. Redeemable debt means at a specific period, after a specific period, 10 years or 15 years, company return their investment, then it is called redeemable debt. Clear? At the time of collecting the debt itself, in their deed itself, they mentioned that this is the period, maturity period for the debentures, debt fund. That is called redeemable debt. 5 years, 10 years, 15 years, 20 years, likewise. Irredeemable debt formula will be I into 1 minus t divided by SV. I into I means interest into 1 minus t divided by SV. SV means sales value. Sales value. Yes. Sales value means issue price. Sales value. SV means issue price minus flotation cost. Flotation. Flotation cost. What is flotation cost? Cost of issue. Cost of, suppose company issued 1 crore debentures to the debenture holders. For issue, company has to pay brokerage to the brokers. That brokerage, that is called cost of issue. Cost of issue. Related to what are the expenses company has to pay, then it is called cost of issue. Issue price minus flotation cost. Cost of issue is also called flotation cost. Okay. Sales value is equal to issue price minus flotation cost. Yes. Redeemable debt. Redeemable debt, shortcut formula and IRR method. There are two methods, IRR method and a shortcut formula. Shortcut formula, KD is equal to I into 1 minus T plus RV minus SV divided by N whole divided by RV plus SV divided by 2. Repeat again. Repeat all. KD is equal to I into 1 minus T plus RV minus SV divided by N whole divided by RV plus SV divided by 2. Yes. I is equal to interest. I is equal to interest. T is equal to tax rate. SV is equal to sales value of debt. What is sales value of debt? Issue price minus flotation cost or cost of issue. Redemption value of debt. Redemption RV the redemption value of debt. Redemption value of debt means maturity paid what amount they are going to pay. Suppose 10 lakh they collected debentures. They are going to pay 15 lakhs to the debenture holders. That 15 lakhs is called a redemption value. Clear? Yes. Number of years. N number of years. Clear? IRR method. IRR already we discussed in capital budgeting. Investment decision. Cost of capital is IRR of debt cash flows. Yes. IRR of debt cash flows. That we will discuss later. Okay. Write down. IRR method is also called present value method. Present value method. Cost of debt. Example 1. AB Limited has issue of 10% debentures of nominal value 100 each. 10% debentures of nominal value of 100 each. The market price is rupees 90. Market price is rupees 90. Calculate cost of debenture. Calculate cost of debenture if irredeemable. If debenture is irredeemable. Case 1. Second case, redeemable at par after 10 years. Redeemable at par after 10 years. Tax rate 50%. Tax rate 50%. Calculate. Irredeemable debenture. Irredeemable debenture. Interest is equal to 100 is the face value or nominal value. The interest will be paid to the debenture holders on nominal value or face value. 100 into 10%, 10 rupees is the interest. 10 rupees is the interest. 10 rupees is the interest. Tax rate 50%. Formula. What is formula? What is formula? What is the formula? KD is equal to I into 1 minus T whole divided by SV. Clear? I we got 10. We got it 10 into 1 minus T. I into 1 minus T. 1 minus 50% 0.50. Clear? What is SV? SV means issue price minus flotation cost or cost of issue. Issue price. Here issue price is market price is given 90. Question specifically given market price is 90. Then issue price will be 90. Consider as 90. Separate issue price is there, you should consider that one. Here, yes, then issue price is 90. Then what is KD? KD. I know 1 minus T, 5 divided by 90. That is equal to 5.55% into 100 for percentage computed multiply to 100 into 100 5.55%. 5.55% is the answer per annum. Company's percentage of cost of debentures. Interest percent of interest is 10%. Company's interest percent is 10%. But we compared as 5.5% is the cost of debenture. Cost of debenture is the interest. in company's point of view. Company's point of view, cost of debenture is interest. Cost of debenture is interest. But interest percentage is given as 10 percentage. But we got 5.5 percentage is cost of capital. 5.5% is cost of capital. Why? There is a difference. 10 rupees is the interest. Okay. Interest is a tax deductible expenditure. Interest is a, that means interest saves tax. Interest saves tax. Interest saves tax. Interest is a tax deductible expenditure. Actually, with concerned with this debentures, company's net cost is 5 rupees. 10 rupees is debenture interest. Because of this 10 rupees we are paying to debentures, we are saving 5 rupees interest. 5 rupees interest. 5 rupees interest is savings. That means net interest to the company, net cost of investment to the company is 5 rupees. Actually 10 rupees is paying, but here company saves 5 rupees tax. That means net cost of debenture is 5 rupees only. Clear? Net cost is 5 rupees. 5 rupees, 5 divided by, for paying this 5 rupees, company collected 90 rupees. Company collected 90 rupees. For this 90 rupees, company is paying 5 rupees. Then 5 divided by 90, 5.5 percentage is the cost of capital. 5 divided by 90, 5.55% is the cost of debt. Clear? Actually, company 10% is 10 rupees is paying to debenture holders. Because company is paying 10 rupees, another side company is saving 5 rupees interest. Company is paying tax. 10 rupees is company paying as interest. Another point of view, 5 rupees tax is company saving. That means net cost of the company is 5 rupees only. 5 divided by 90, 5.55% per annum. Clear? Yes. Next, redeemable debentures. Redeemable debentures I into 1 minus T plus RV minus SV divided by N whole divided by RV plus SV. This is the formula. Okay. Then I 10 rupees, 10 rupees, 1 minus T, 1 minus 0.5 plus RV minus SV. RV is redemption value. RV is redemption value. RV is redemption value. Here you need to write the RV, the redemption value. Redemption value RV 100. Sale value SV 90. Clear? Then 5 plus 1 divided by 95. 5 plus 1 divided by 95, that is 6.31 percentage is KD. In case of redeemable debt, KD is 6.31 percentage. 6.31 percentage. Clear? 6.31 percentage. Listen here. If it is a redeemable debentures, what is the concept behind this one? Company is paying 10 rupees to the debenture holders. Okay, each year company is paying 10 rupees to the debenture holders. Company saves tax. 50% company tax is saving. That means benefit to the company is 50%. That means net cost of the company for this debenture is 5 rupees. 5 rupees. Actually, company needs to redeem these debentures after 10 years. 10 years. 10 years at the end of 10th year, company needs to pay 100 rupees. Company needs to pay 100 rupees. Actually, company issued these debentures at 90 rupees. Issued the debentures at 90 rupees. Company is going to pay this redemption value 100 rupees. That means 10 rupees extra company pay at the time of redemption. Clear? This 10 rupees company is paying not only for 1 year, it is for the whole year, for the 10 years. That means 100 at the terminal year or maturity period company is going to redeem this amount. 100 minus 90. Company is issued at rupees 90. The same debenture company redeemed at rupees 100. That means extra company is paying 10 rupees to each debentures for the each debentures for 10 years. For 10 years. That means for 1 year, what amount have to be paid for this redemption value? 1 rupee. 1 rupee. Yes, clear. That means 5 plus 1. For each year, company's cost is 5 rupees interest plus 1 rupees for proportion of redemption value. Clear. 6 rupees is company is paying. Clear. This 6 rupees company is paying is company's issue price is 90. Company's issue price is initial issue price is 90. Redemption value is 100. That means average investment or average collection amount or average capital is 95. Opening plus closing divided by 2 is average investment. Clear? Company collected 90, company redeemed 100. That means average cost of capital is 95. Clear? 5 plus 1, 6 divided by 95. That is 6. That is equal to 6.31 percentage. 6.31 percentage. This is the concept. Clear? I think you got it. This idea. Clear? Okay. Yes. This is redeemable debentures. Redemption. Suppose redeem at 10% premium. In that case, instead of 100, you need to take 110. Clear? Issued at a discount. Discount price you should reduce. Clear? Clear? Not redemption value issued at premium, issued at redeem at par, redeem at premium, issued at a discount. Different ways they can give. Clear? On the base of redemption value and sales value may be different. Clear? Suppose cost of issue or flotation cost also may be given in the question. Okay. One more point. Here, KD is equal to I into 1 minus T divided by SV. Clear? Okay. Here, SV means sales value or cost of issue. The C means sales value or cost of issue. Suppose company issued in same face value. Company issued at a same face value. In that case, KD is equal to I means 10. 10 into 1 minus 0.50 divided by 100 into 100. If you mention in percentage, 100 into 100. Okay, what is the percentage? KD 5%. 5 percentage. Clear? If it is issued at a face value or nominal value, the formula will be, you can simply write it as I into 1 minus tax. Divided by SV not required. Why? If it is issued at a nominal value. If it is issued at a nominal value or face value, the formula will be KD is equal to R for irredeemable debt. I into 1 minus T. If the sale value or issue price is different from face value, then you should divide issue price. Issue price minus flotation cost or cost of issue. Clear? Yes. This is KD. Then KP. KP is similar to KD. Simple. Same. KP means cost of preference shares. Cost of preference shares. Irredeemable and redeemable. Irredeemable and irredeemable preference shares preference shares. Irredeemable preference shares that capital preference share capital company won't repay to the preference shareholders. That will be paid only at the time of winding up of the company. Clear? Irredeemable preference shares formula will be PD divided by SV. What is PD? Preference dividend. Preference dividend is a after tax item. Preference dividend company paid after tax. Then 1 minus T not required to be adjusted in preference dividend. Clear? Interest is a before tax item. I into 1 minus T. Clear? Hence, KP is equal to PD divided by SV. Preference divided by SV. Clear? Okay. Redeemable debentures same like it. Yes. Two method is the conceptual method. This means IRR method. This is shortcut formula. Shortcut formula. Then another method IRR. IRR method. IRR method is the IRR method as we discussed in same capital budgeting. Shortcut formula and formula will be PD. Same formula what we discussed in KD. PD plus RV minus SV divided by N whole divided by RV plus SV divided by 2. Clear? Here PD means preference dividend. IRR method or present value method. Present value method. PD means preference dividend. RV as you know redemption value. SV as you know sales value, that is issue price minus flotation cost. Redemption value, sales value, issue price minus flotation cost. Okay. Example, another example 2. AB Limited has issued 14% preference shares of face value 100 each. Of face value 100 each to be redeemed after 10 years. To be redeemed after 10 years. Flotation cost, that means cost of issue, is expected to be 4%. 4%. 4% on face value you can compute. Determine the cost of capital, cost of preference shares. Yes. Flotation cost is expected to be 4%. Determine the cost of preference shares. Compute. Yes. Calculation of KP use shortcut. Whether this is a irredeemable debt or a redeemable debt. Redeemable debt. Redeemable debt. Preference dividend is 100 into 14%, 40. 100 into 14%, 14. Flotation goes 100 into 4%, 4. Sales value 100 minus 4, 96. That means 100 is face value, 4 is issue price, cost of issue, 96. Redemption value rupees 100. Clear? Okay. KP is equal to PD plus RV. This is a redeemable debt. After 10 years, redeemable after question specifically mentioned redeemable after 10 years or 5 years, then it is a redeemable debt. Otherwise, it is a irredeemable debt. Clear? PD plus RV minus SV divided by N, RV plus SV divided by 2. 14 plus 100 minus 96 divided by 10. 100 plus 96 divided by 2. Yes, the answer will be 40.69%. Clear? This concept of this formula we discussed in KD itself. Shortcut formula of cost of debt. The same concept is applied here also.